Good afternoon and welcome this afternoon to Advanced Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend James Boyd. He's a 20 plus year veteran of the financial markets. Great educator in his own right and a good friend, and I'm glad to have him here helping to facilitate that conversation, keep that conversation going out there in the chat. Welcome to all of you, whether you're here with us live or watching the recorded version. Either way, be a part of the conversation by chatting in your question or leaving us a comment in the comment section. So we're going to jump into this discussion of advanced option strategies today. And I'm glad I had this opportunity to kind of sit in on this particular webcast because it's not one that I normally teach. It is one that, for those of you that have been out on the one of our live events, you know that we sometimes will drop into when we do an example of a live webcast. But the reason I'm excited about this one today is very simply this. I have been teaching for probably the better part of 2 years our index options webcast because of some different assignments and things going on. Connie Hill has been teaching that one for me, and likely to do so for the near future. Now, one of the common questions that I got when I was teaching that particular webcast was around a particular strategy that I used. The strategy was simply selling a vertical spread, so creating a multiple leg option strategy, which falls, I think roughly under the characteristics of what we would call an advanced option strategy. Um, but selling that on the S&P 500 options, index options, at 14 days to go until expiration, and then buying it back at 7 days to go until expiration. And what oftentimes would happen, I mean, like every week, is I would get questions about, well, why don't you, or could we do this, or why don't you do this in terms of changing the strategy? My point of putting the strategy together the way I did was to establish consistency. Now I don't have to do that. Connie gets to do that. So now I get to play around with it a little bit. So we're going to talk about that strategy. We're going to turn it into a couple of different things here in the discussion today. And then I've got another strategy that is a little bit of a put back ratio spread that looks for some movement. So we'll take a look at both of those today. A couple of quick housekeeping items, though, that we need to take care of. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice or solicitation of any particular security or strategy or account type or anything else. Remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that if you're trading spread trades, that has to be done in a margin account. Multiple leg option strategies can entail multiple transaction costs. The long side of option trades, investors can lose 100% of the funds invested. The short side of the option strategy, of an option strategy, if it's an American style option, may result in early assignment. That's something that we'll talk about. If you're trading an index option like a European style option, those are considered to be European style. They don't allow for early exercise, which means that there is no early assignment on an index option. Index options are cash settled instead of settling to shares of or a short position in an underlying stock. So we'll talk about those. We'll get into this discussion. We're going to use the Thinkorswim desktop software platform, specifically the paper money version of the platform, which is a great learning environment. It's not a guarantee of future success out there in the real world. And it doesn't do certain things like early assignment of short options. It doesn't fill based on market forces. It fills orders based on the midpoint. So as you move your practice from paper money to live trading, make sure that you're aware of those characteristics. Also, when you're trading near expiration or holding options all the way to expiration, make sure you understand that there are some specific risks, including lack of liquidity, including high gamma, which can create some circumstances where losses can accumulate and mount very quickly. Uh, be aware of that, and be aware of the fact that Schwab can and may, but has no obligations to liquidate positions prior to the close of trading, whether it's in the money or out of the money, depending on market forces. So we'll talk about that as we get into this discussion as well. The other thing I want to pay attention to, remember, is that past performance, no guarantee of future results. And technical analysis, something that we're going to use in this discussion, isn't a guarantee, but neither is fundamental analysis, neither is probability analysis. So let's jump into this discussion here today as we pop over to the Thinkorswim desktop software platform, take a look at what's going on, and see what's happening in today's trading. Last Friday of trading in June. Holiday shortened week next week because of the 4th of July holiday observed on Friday the 3rd. And we see that the S&P 500 today, we saw a little bit of a gap down and a bit of a rally. I'm going to zoom over here to the right-hand side. And now just barely moving back up above that 50-period simple moving average. So bit higher low, bit of a bounce here. We might even take that diagonal trend line and extend it back down this way. We still have a rising wedge type of pattern, which can potentially be bearish, maybe even a little bit more bearish than a symmetrical triangle, but at the same time, the trend is still up. We're still making higher highs, higher lows, not yet necessarily higher highs, but that may just mean a pause. Taking a look at the NASDAQ, a little bit stronger bounce today, although it was a bit of a stronger gap to the downside, and it struggled back. So we saw some movement back to the upside. Russell 2000 continuing this little bit of an upward climb, although you would maybe argue from a technical perspective, and we talked to Rachel Deshelle about this as well, that we've got a rising wedge here, which can be, rising wedges can be potentially bearish. But we're going into the rebalance of the Russell 2000 today and into next week. So that may change the nature of this particular index as it rebalances every year and adds or subtracts components based on weighting and performance and a few other things. So the Russell 2000 might be back down a little bit, but that kind of encompasses what's gone on with the market today. It's been a little bit of a gap down and a rally type of day as we go into the end of the day. And Josh says, yeah, the Russell is reconstitution. That rebalancing might impact the index, and at least at the moment, it's giving a little bit of upward movement, but same kind of thing you're seeing the last few days here. It's really been chopping sideways. So I think you got to give it a couple of days as all of those funds that hold or mimic or follow the index kind of rebalance their books and move things around. And as they are bound to do, there may be just more volatility as this moves up and down a little bit here. But one other thing I wanted to look at really quickly before we jump into some specific trades is what's going on with volatility today, and taking a look at the VIX. We saw a pretty healthy move to the upside. I mean, we were up in the mid 20, almost high 20 handle earlier today, and that's kind of slipped back a little bit given the fact that the market kind of rallied back and challenged that. So we're still above the 50 period, or excuse me, the 30 period moving average of the VIX. So if we zoom over on the right-hand side here. Now remember, the VIX doesn't necessarily behave in that normal way that we might think of support and resistance, because the VIX index in and of itself is not a tradable instrument, although there are options available on the VIX index, and there are futures contracts that trade the performance of this. We're not going to talk about those outside the scope of this discussion, but I do talk about it on Tuesday mornings in my Trading Futures webcast. But this little bit of a gap up and sell-off in the VIX today brings that volatility right back up to the mid 18 handle or so, about 18.6, which, if you look back historically, is just a little bit higher than the typical range, but it is not exceptionally high, nor is it exceptionally low. It's staying a little bit higher. We've got a few things We're in that gulf between earnings seasons. We've got a lot of economic data that's squeezed into a few days next week. And so that's going to maybe bring a bit of elevated implied volatility and until we start to get into some of those early earnings reports as we start in the next couple of weeks in the airlines and in the bank space and so forth, as that process starts to repeat itself once again. So relatively high, but somewhat falling volatility. And that being said, if the market does continue to rally, we might see volatility start to fall off even a little bit more. So we've got higher and falling volatility. That kind of applies across the board. So now what I want to do is I want to go back to this strategy that I talked about. And the idea around this particular strategy, I'm going to just change my grid here to my index options grid, which is right here. And the index options grid is nothing more than a side-by-side panel. I've got S&P 500 one-year, one-day chart and a 3-month, one-day chart on the right-hand side. Just a narrower view, just a more focused view on the right-hand side. But what I do have on the right-hand side is a probability of expiring cone that shows a 1 standard deviation range at different times. So each one of those dots represents kind of a crossing of that particular timestamp forward and that 1 standard deviation level. This cone will widen or narrow based on higher or lower implied volatility, which I've got down here in the lower panel on the right-hand side. Implied volatility, again, this is rough approximation of the VIX. This calculation is a little bit different than the VIX calculation, but it's going to get you to just about the same place. And you see the implied volatility relatively high, not the highest that it's been, not spiking, but relatively high for where it's been in the last month or so, and starting to move back down. Mean reverting is generally the scenario here. So implied volatility may be starting to bleed off a little bit. So what we're going to do is the basis of this strategy is we create an order to take advantage of directional movement. And we do it at 14 periods or 14 days to go until expiration. And then we buy it back, at least the way that we did it in the index options class, and the way that Connie's still doing it there, is we bought it back at 7 days come what may. And we just did one side. We just did a short vertical spread, or we just did a short put vertical spread or a short call vertical spread. What determined whether we chose a short put vertical or a short call vertical was where price was relative to a couple of things. Now, I was using and did use for a long time the 200 period moving average. And if the price of the index was above the 200 period moving average, we sold put spreads because the assumption was that it was bullish. If it was below the 200 period moving average, the method was to sell call spreads. And there was only one real time here where we sold call spreads. And we kind of got whipsawed out of a couple of those because we saw some very quick market movements back to the upside in that time frame. And then it continued to run. Now we're at a point, and I'm going to kind of shorten this up here. And one of the common questions was, well, could I use a shorter moving average? Do I have to use that 200 period moving average, or can I use a shorter moving average, like a 50 period moving average? That's what this orange line is, and make the determination whether or not the index is above or below the 50, then make that determination. So above the 50, sell a put spread. Below the 50, sell a call spread. So here's where we are today. I'm going to expand this left-hand side. And this is exactly the scenario that I wanted this to be at so that we could talk about this. Because right now, the index is almost exactly at the 50 period moving average. Simple moving average. So what do you choose? Do you choose a short put spread and then it moves even lower because it's right at and moving down through the 50 period moving average? Do you sell a call spread and then it moves up because it's moving bullishly into that 50 period moving average? That presents the conundrum. So why don't we just answer the question by saying let's do both and see how that works. And see how that might play itself out as bogus chinchilla. I love that username, bogus chinchilla. It's like, you're not a real chinchilla, you're a bogus chinchilla. Cool, I like that. All right, so here's what we're going to do. We're going to create an iron condor essentially around this movement. And we're kind of sitting at that sweet spot, if you will. The index is from the standpoint of using some kind of a directional indicator. Momentum's starting to pick up, but we got a downtrend sitting right at the 50-period moving average. We had a gap down and a rally. Implied volatility is relatively high and potentially falling, but it's not the highest it's ever been. So here we are. So what do? Well, the first thing you're going to do is I'm going to go right here to the trade tab and I'm going to figure out where 14 days to go until the expiration is. And remember, one of the nice things about trading an index, that's Microsoft. I don't want Microsoft. I want SPX. Okay, cool. One of the cool things about SPX as an index option is that it gives us daily expirations, Monday through Friday, daily expirations. So there's a lot of granularity. So we were doing it on Wednesday simply because the webcast was taught on Wednesdays. We're going to do this one on a Friday, which is fine because that works kind of nicely into this. So we're going to go to the 10 July, which is a Friday. All right. I'm going to go to that 10 July expiration. So what I'm going to do is I'm going to come over here and I'm going to go to my right-hand side chart, which has that probability of expiring cone, has implied volatility on here as well. And I've got this vertical line, which is down here in the drawing tools. If you come down here to that time level, that's that vertical drawing tool. And I'm just going to activate it by clicking right on it. And then I'm going to move it out to the 10th of July, which is 14 days to go until expiration. Now, without going deep into the discussion of why 14 days, the idea is this. Since we're selling out of the money options tend to decay more rapidly in the first week of their time frame that you hold them, and then slow down as you get close to expiration. That normal theta curve that we're expecting kind of inverts itself a little bit. So now that we're closer to expiration, theta becomes a bigger deal. I want to capture the majority of the time decay in the front week, as opposed to looking to get out of it, as we get closer to expiration, and expecting that the majority of the time decay is going to come out here and then accelerate as we get closer to expiration. So it kind of does something a little bit different than we might expect. Speaking of what's a little bit different, although something completely expected, is the fact that there's a feedback survey out there in the chat, and James is going to repost that for me. It is right there. Just fill that out. Let us know what you think and help us to make these webcasts better. So I've pushed my timeline out to the 10th, and I'm just going to take my line tool and I'm just going to do a cross here at 7101. I'm going to call that 7100 just for easy math, because I don't think I'm going to have a 7101 strike price. Now, the other thing I'm going to do here, since we're right here, is I'm going to go up to the probability of expiring cone up here on the top side. Because remember, this should be equidistant, top and bottom. This is one standard deviation up or one standard deviation down. So in fact, you can change that if you want to skew that probability of expiring cone. You can skew that a little bit if you wanted to, but we're going to use the same probability. So I'm going to go 7650 on the top side, and I'm going to go 7101 on the bottom side. Now, what that's going to do is that's going to create a fairly wide range. So you think about it, that's a one standard deviation range, top and bottom, from where the price of the stock is now out to the next week. There's another way that we could do this and kind of validate this, and that is expected move. If we go back over here to the trade tab and we go to the 10 July expiration, that's this one right here. That's 14 days to go until expiration. And we go out here to the right side and we see that the current implied volatility is 17.42%, but the expected move up or down from this point out for the next 14 days is 201 points up or down. So think about it, 200 points from here up is 70, what is that, 75.60? So where are we here? 75.60. We're okay, a little bit under exuberant there. And if we go the other side, 200 points down is 7,100 or 7,160, so we're at a 7,100. So that standard, that probability of expiring cone, a little bit further out, a little bit broader range than just the implied volatility driven expected move, which is fine. If I can sell outside that range, great. That being said, I might bring it inside that move just a little bit too, depending on how much premium there is to be had in this particular trade. So what we're going to do is we're going to come back down here to this trade. I'm going to put this on singles, and I'm probably going to have to open up the number of strike prices here. So I'm going to go to 120 strikes and see if that gets us to where we need to be. Let's start on the put side, because that's kind of where we normally would start with our put spread on the index options webcast. So we're going to go to the 7,100. Now, remember, a couple of things. I want to talk about this real fast. These are cash settled options because you can't buy the index. They are European style, which means that they cannot be exercised until expiration. So there is no early assignment on these short legs. So no early assignment means that if it's dealt with prior to expiration, there's no theoretical risk of having that obligation put to you unless the index moves and you hold it till expiration. So just be aware of that when you're talking about index options here. So we're going to look at selling the 7,100, and I'm going to make this 20 wide just like I've done before. So 7,100, and I'm going to make this 20 wide. So I'm going to go to 7,100, and I'm going to go to the 70.80 to buy that 70.80. $2.10. Now, here's where this kind of gets funky. $2.10, we look at confirming and sending, and we've got $1,700 worth of risk against 205 credit. All right, cool. The next question is, why are we taking so much risk for so little premium? Well, it's a high probability trade. So that's kind of what's putting us out in this range. So that's our first kind of side of this trade. That's the short put spread. And if we were teaching the index options webcast, we would stop right there. We'd say, cool, let it go, and we're going to buy it back next week, come what may. But we're going to break this apart a little bit. So the next thing that we're going to do is we're going to go over to the other side. And we said, hey, look, where are we on the top side? We're at 76.50. So let's go back to our trade tab, and let's come over here to the call side. We're going to scroll down, and we're going to find the 76.50 strike. Here's 76, that's 75.50. Here's 76.50, which 76.50 is way the heck out there. I mean, that's like the 5-cent delta. Huh. All right, well, let's see what we can get out of this, just in any event here, right? Selling the 76.50 and buying the 76.70, 20 wide. We'll make that 20 wide. We're not bringing in very much premium. We're adding about $1 of premium to the trade, but we're reducing the risk a little bit, right? So we've dropped the risk a little bit. We've added a little bit more to the premium. Now, that would then induce us to think maybe we skew this a little bit, because if we leave it right here, look, if we leave it right here, let's right click and let's go analyze trade, and we're going to throw this over here on the SPX. There's kind of, we're boom, right down the middle of that probability of expiring range, right? So that would assume if nothing happens, this is the scenario. But look, that's $305 for 2 weeks. So here's the breakdown of this. This is delta neutral, kind of following right in the middle of the range here. Delta neutral. It's bouncing back and forth because we've got short deltas on both sides. It's bouncing back and forth between about 2 and 3 deltas, like 2 or 3 deltas. It's not very directionally sensitive at all. We're still far enough out that gamma hasn't become a big issue. And we're far enough out away from the at the money strike that gamma is not likely to become a big issue unless this starts to threaten one side or the other. But as we get into that last week towards expiration, probably realistically into those last couple of days prior to expiration, gamma is not going to become significant, especially way out here wide. If the price of the index just keeps going in the middle, that's fine. If it starts threatening one side or the other, gamma is going to pick up on one side, but it's going to decrease on the other side. And so gamma may not be as big an issue here because we're balancing it with the other side. Theta, this is collecting theta for us, right? So this is working in our favor to the tune of about 23 cents a day. And notice the negative Vegas. Notice the negative Vegas. This is pretty significantly Vega sensitive. So this becomes even more so than a theta trade. With both of those trades working, this becomes a pretty significant theta, or excuse me, Vega trade, right? So Vega, if implied volatility drops, which if the market goes up or it stays where it is, implied volatility is likely to stay where it is. Now, the problem is if we get a spike in implied volatility, that can hit us in this type of trade where you've got a pretty sensitive Vega number. And if that implied volatility does spike up, which it potentially could, then that could be a challenge to this particular trade. So from this standpoint, now, theoretically, since this is an iron condor, which means I've got a short vertical spread above and a short vertical spread below. Barbara Armstrong calls this a short vertical sandwich. For obvious reasons, you've got a short call vertical above, expecting the price of the stock to go or the index to go down. You've got a short vertical spread or a short put vertical below, expecting the price of the index to go up. And you're kind of sandwiching that expected range of movement in that in between those two short strikes. But you notice that, again, this has a fairly wide area of max theoretical gain, right? Fairly wide area of max theoretical gain, which makes it high probability. But because it's high probability, you've got a small theoretical max gain and a big theoretical max loss. So Chris asks a really insightful question. Is that Vega sensitivity so large because of the width of the spreads? Because we're using 20 wide spreads. And the answer to that is yes, to a certain extent. Yes. Let's see what happens if we were to play with this a little bit. So let me kill that annotation. And I'm going to come back over here and we're going to make these 10 wide because now that we've got really, if you think about it, risk definition in both directions, right? Risk definitions in both sides, we may be able to reduce the amount that we're creating, or the amount of width in those spreads that we're using, which means that we're going to sacrifice a little bit more of our premium. So we may get less absolute premium here, but it's going to reduce our risk and it may, in fact, change our Vega. So keep an eye on that Vega number, right? So let's change our long legs to, let's make this 10 points wide. So we're going to go to 76.80 instead of the 76.70. And we got to unlock our lock there. And let's go to our long put leg. So we're going to make that 70.90 instead of 70.80. Or did I go the other direction? No. Let's see. I went the other way. I wanted to go, we were at 70.80. I wanted to go to 21. Right? Oh boy. Let's see. I got to go back to let me go back to the option chain and look at this real fast. Because sometimes, you get thinking about these things. So we sold the 7,100. We got to scroll back down here. 7,100, and we bought the 70. So I'm buying the 70.90. Come on, what's going on here? 71.90 or 70.90. Let's make that the 70.90. Oh, did I go the opposite direction in the call side? Maybe that's what I did. Let's just look at it on the option chain. This is also what happens, right? So let's go to our trade tab. We sold the 76.50. 76.60 is what I wanted to go to, right? 76.60. That's what I did. I went longer on that side. I wanted to come back in. There we go. Now that brings it back down. So we're getting about half, a little less than half, or a little more than half of what we were getting before. $1.60 in credit, but our Vegas sensitivity was just about cut in half. And so you're right, Chris. To adjust that, we could bring those spreads wider, but at what cost? The cost of some of that premium. Now, our defined max loss here, now there could be more max loss than that, but our defined max loss is $835 against $165. So kind of the same equivalent, if you will, percentage wise, but it makes it maybe a little bit more palatable from a margin standpoint. Um, and yes, Sam, you said we get as you pointed out, we get a free day of theta without any trading, right? So I'm going to fire this order off. I'm going to put this in, I'm going to keep it at this 10 wide just to see how this behaves. We're going to go ahead and put this in our index options group. We'll go ahead and we'll fire that order off and send that, and we'll see if that, and there we go. So we got $1.65 for it. Cool. Now, the other trade that I wanted to put together here really quickly was one that Kevin Hinks and I talked about this morning on Fast Market on the Schwab Network, which is brought to us by our media affiliate, Charles Schwab Media Productions. So let's pop over here to our grid once again, and I will restore these cells. So we were looking at this one, and this is MSFT, Microsoft. So kind of looking at this bounce up off of this support level. So here's the thing. This is a fairly bullish, from a technical perspective, a fairly bullish possible bounce, right? As we start to see this move back to the upside, thinking, hey, we've got a declining 50-period moving average. I've got the 200-period moving average that's just kind of rolling down a little bit here. I've got some negative momentum. So we may see some downside movement. That may be the directional movement. But what if it goes up? So I wanted to start with this idea of creating a short put vertical spread. So we're going to do that first. So we're going to create a short put vertical spread. Notice that implied volatility is relatively high and could possibly continue to come to the downside. It's at the 85th percentile, but you've got an earnings announcement just over the relative horizon here a little bit further that could keep implied volatility elevated somewhat. So I'm going to go to the trade tab here for Microsoft. And I don't need 140 strikes in this, but what we're going to do, I know that the earnings announcement's on the 30th of July, so I'm going to actually out just past that. I'm going to go to the 31 July expiration, 35 days to go until expiration. Expected moves about $40 between now and then. I'm going to open this up, and we're going to look at selling that put spread. The put spread that I want to look at selling here is selling right around the 400 strike put and expecting some movement, right? And as we put this together, let's see. Yeah, I want to sell that 400 strike because I had made some notes on this. So we're looking at selling that 400 strike put. So slightly in the money in this particular case. So I actually need some movement here in order to put this in that scenario of being out of the money, right? But I'm going to sell that 400 strike put option slightly in the money in this particular case. And then we're going to create a vertical spread by buying the 360 put. Okay, so now that's bullish, right? We're bringing in $23.25. And if we stopped right here, this is a vertical spread that would require some movement. If we right-clicked and we set this to the Analyze tab, and we looked at it from this standpoint, there's our short put vertical spread. It's got to have some movement in order for us to get to that point of breaking even in the trade or making money in the trade. And it's got to move upside. Remember, this is the bullish scenario here. What if it goes down? So let's add one more thing to this mix. Let's go back to our trade tab, and we're going to add one more thing. I'm going to just make this change this from vertical to custom, because now what I'm going to add is I'm going to add one more put option, one more of those 360 puts. So we're going to create a back spread. So we're going to add 2 put options. And yeah, it's a couple of strikes in the money here in this particular case. Fair enough. So what I'm doing now is I've reduced my credit, but what I've done is I've bought a long put extra on top of that vertical spread that I created, still getting a credit for it, but now I've given myself the opportunity to take advantage of downside movement if it does go to the downside. All right, so here's what we're going to do. I'm going to send this to the Analyze tab. And if I put this on the Analyze tab, and let's take that other vertical off, and let's kind of squish this in a little bit here. What we've done in this trade, let me kind of squish this around so that you can see how this is working. Okay, and I'm going to go out to my July 31st expiration, and I'm going to set my slices to my break even in this trade. So there's my break even points. 329.72 to the downside, 390.30 to the upside. This is not a zebra necessarily. It is sort of, but a zebra, to answer XSVL's question, specifically a zero extrinsic back ratio spread, would be leading with a long vertical spread and selling one and buying 2, but in kind of flipping that over directionally. So a zebra spread is going to look fairly similar, but it's going to have a different risk profile just because it's created a different way. So this is just simply a short put vertical spread, just like what we were doing on the Iron Condor for the SPX. It's got a directional expectation of an upside move, just like a vertical spread does. And it's got a capped upside if the price of the stock keeps going up. So I've got a bullish bias, but at the same time, I get some benefit if it does go down. Now here's, and shave a little bit off of that for some protection. But here's the thing. If this just does nothing, if it just stays where it is, if it moves towards that long strike of the 360 strike where I'm long those 2 and stays there, worst possible scenario, because that puts me at my max theoretical loss in the trade. So if we right click, we do confirm and send, here's my max profit, right? Price of the stock going all the way to 0. It's not infinite gains, but it's pretty substantial. But the thing about it is it likely that Microsoft is going to go to 0? Probably not. But look at the max loss on this trade. Max loss on this trade is if at expiration, this is at that 360 short strike. So what we're going to do is this gets closer to expiration, take it off or adjust it. Maybe roll off that long put and let the vertical play itself out, or close the short leg and leave those 2 long legs in place, because at that point you've got essentially a paid for long straddle. So a couple of different ways that we can approach this. So what I'm going to do is I'm going to put this in our I'm going to put this in the long options group just so they can come back and play with this and see what it looks like on an ongoing basis. And so I just killed that trade, sent it off. We sold it for $10.20, but the expectation here is in Microsoft, either we get some upward movement and it goes up above our break even to the upside, or we get some downward movement and it goes below that support level to the downside. Let me put that trade on one more time. I'm going to put that trade together one more time just to kind of walk through it. There it is right there. And I did it as a custom. but it is creating essentially a short put vertical spread with the long leg out of the money, the short leg in the money. So I've got directional expectations here. If we were just leaving it at the vertical spread, in order for this to be directional and get to max theoretical gain, price of the stock's got to go above 400. We've reduced a little bit of that by creating that long put vertical, or excuse me, the long put, adding one long put to our back ratio spread here, getting it for $9.30 credit. If we right click, let's send it back to the Analyze tab so that we can see this again. And once again, let's kind of set this to, I'm going to set this to, we'll do 10 plus 10 minus 10% and base. Price of the stock right now is at 370.46. So, problem is, this is directionally sensitive, not hugely directional sensitive. It's going to have a fair amount of gamma as it gets closer to expiration, but it is theta positive or negative because we've got two long legs. So we're paying for theta instead of collecting theta. But if implied volatility goes down, that works against us a little bit. If implied volatility goes up, because if this starts to go down to the downside, implied volatility is going to go up. That's going to work for us in this particular case. So assuming Microsoft goes up, what's the purpose of buying the second put? It gives us directionality in both directions. It gives us the ability to be wrong one way or the other way and still take advantage of that gain, that potential gain here, and doing it for credit, right? Essentially creating almost a straddle, long straddle for a little bit of a credit and limiting our maximum loss. Yeah, fairly small price for that. All right, guys. Hey, real quick before we go, let me pop back over here. If you want to learn more about strategies like this, pop over here to the Trader Talks webcast page. Give us a follow right here if you haven't done that before. Click on that subscribe button, and you're going to be able to find concepts like this. If you type in back ratio right there. Here's Connie talking about back ratio spreads. Here's Brent talking about back ratio spreads, in fact, with zebras. Here's me talking about zebras and back ratio spreads, directional option skew, and a bunch of other webcasts. Also, if you want to learn more about this from Kevin Hinks and myself in our advanced options event, our live workshop, I'm going to pop this schedule up really quickly. We're going to be in New York the weekend of August 28th and 29th, teaching our next advanced option strategies workshop. Love to see you there. If you want to come and join us, if you're in the New York area, we're at the Marriott Marquis, right in Times Square, great property. We're going to be in Chicago again in a couple of weeks, teaching technical analysis and option strategies. Then we're going to be doing a market drive in Dallas, and then I'm going to be down in Orlando again. Love coming down to Orlando, so love seeing all of you out there. Again, my thanks to James Boyd for helping to answer questions today, keeping that conversation flowing. Thanks to all of you for being here, and thanks for joining us. We'll see you guys again very soon. Have a great weekend. I'm going to be in the Chicago office all next week, so you'll be seeing me in a lot of different places. And have a great, safe holiday if I don't see you before then. Take care, everybody. Bye-bye.